Hello everyone, myself Dr. Mathiyarasan, Department of Commerce from School of Commerce, Accounting and Finance from Kristu Jayanti University, Bangalore. Today we are going to discuss about financial forecasting from corporate financial management subject. Now we are going to say about what do you mean by financial forecasting. Financial forecasting is the process of estimating the future financial outcomes for a business based on the historical data, current economic conditions and various compositions. It is a framework that presents estimates of past, current, and projected financial conditions. It involves predicting the future revenues, expenses, profits, cash flows, and other financial metrics to assist in decision making and planning and budgeting. There are two primary categories of forecastings, financial forecastings are there. The first one, quantitative one, another one is qualitative one. There are different techniques under the quantitative as well as qualitative techniques are there. Under the quantitative techniques, we have the percentage of sales, straight line, moving average, simple linear regressions, multiple linear regressions. Even under the qualitative methods, we have Delphi method and market research. We'll be moving to see about quantitative method. So quantitative methods, it talks about only the quantitative data, and in there the first method is called percentage of sales. The percentage of sales method is the forecasting tool that makes financial predictions based on the previous and current sales data. This data encompasses the sales and all business expenses related to sales, including inventory and cost of goods. Forecasted sales can be calculated by using the formula current sales multiply with 1 plus growth rate divided by 100. The second technique is straight line method for calculating the financial forecasting. This method assumes a company's historical growth rate will remain the constant. Forecasting future revenue involves multiplying a company's previous year's revenue by its growth rate. For example, if the previous year's growth rate was 12%, the straight line forecasting assumes it will continue to grow by 12% even the next year. Although the straight line forecasting is an excellent starting point, it does not account for market fluctuations or supply chain issues. The third technique is moving average. It involves taking the average or weighted average of previous periods to forecast the future. This method involves more closely examines a business high or low demands. So it's often beneficial for short-term forecasting. For example, you can use it to forecast next month's sales by averaging the previous quarter. While it's most commonly applied to future stock prices, it's also used to estimate the future revenue. To calculate a moving average, we can use the following formula: A1 plus A2 plus A3 and plus etc. divided by N. A represents here average for the period, and N represents total number of periods. The fourth technique here, simple linear regression. It forecasts the metrics based on the relationship between two variables, especially dependent and independent variables. The dependent variable represents the forecasted amount, while the independent variable is the factor that influences the dependent variable. The equation for simple linear regression is y equal to a plus bx. Here, y represents dependent variable, that is the forecasted number, and b represents the regression line slope, and x represents independent variable, and a represents y-intercept. The fifth technique here, multiple linear regression. If two or more variables directly impact a company's performance, the business leaders might turn to multiple linear regression. This allows for a more accurate forecast as it accounts for several variables that ultimately influence performance. To forecast using multiple linear regression, a linear relationship must exist between the dependent and independent variables. Additionally, the independent variable can't be so closely correlated that it's impossible to tell which impacts the dependent variable. The next method here, qualitative methods. So that means here we are going to forecast the data based on the qualitative data only. Here the first method is Delphi method. The Delphi method of forecasting involves consulting the experts who analyze the market conditions to predict a company's performance. A facilitator reaches out to those experts with questionnaires requesting forecast of business performance based on their experience and knowledge. The facilitator then compiles their analysis and sends them to other experts for comments. The goal is to continue circulating them until a consensus is reached. The next method, another qualitative method, is market research. So it is essential for organizational planning and it helps business leaders obtain a holistic market view based on competition, fluctuating conditions, and consumer patterns. It's also the critical for startups when historical data is not available. New businesses can benefit from the financial forecasting because it's essential for recruiting investors and budgeting during the first few months of the operations. There are different types of forecasting involved: sales forecast, income forecast, financial position forecast, forecasting for growth and external funds requirements. We'll see the first one, sales forecast. Sales forecasting entails predicting the amounts of products or the services the organization expects to sell within the projected fiscal period. It has many uses and benefits, including budgeting and planning production cycles. The second one, income forecast. This entails analyzing the company's past revenue performance and current growth rate to estimate the future income. Third one, financial position forecast. It is also known as a balance sheet forecast. It is a projection of a company's financial position at a specific point in the future. It provides an estimate of a firm's assets, liabilities, and equity based on anticipated financial activities and transactions. The fourth one, forecasting for growth and external funds requirements. It involves estimating a company's future financial needs and requirements, particularly in the context of planned business expansion or growth.